John, what are we talking about today?
Well, you know what's an unstable market when feeder cattle are the safest asset on the board. No, actually, my client said that to me today. I promised him I'd use it. I don't think he wanted me to. I just promised him that I would. And you know what? It makes perfect sense. It's exactly right. That's when you know the markets are off the rails, when flight to safety is feeder cattle.
Welcome to Hedge Heads, where hosts Jon and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, does it get better than a 60-degree day in March in Minnesota?
Yeah, what are we doing in a podcast studio?
Oh my gosh, we are missing out.
I went and sat in the sun all day long. If you're from here, yes, that was yesterday. If you're from here, there's nothing better than that after a long winter. And it hasn't been too terribly long, but that was overdue yesterday. And I was out all day long. I might even got some Minnesota sunburn.
I don't tan. I only get burned, so it doesn't matter when that is. It's the Norwegian tan, as I call it.
The vitamin D, it was great. It just kind of, I'm ready for spring. I think everybody else is, and we're going to be underway here very soon. This doesn't feel like it's going to be behind this year.
Yeah, I mean, we said that last year, too, and then the weather changed.
I did just jinx it. I think I've jinxed it every year.
We just had that bomb cyclone, too. I mean, we love bomb cyclones around here. Those, and what are they called? Derico?
I always call it super heavy winds because I don't know how to say it. The one that knocked all that Iowa corn down that one year.
Yeah.
Let's enjoy what we have now. But yeah, Friday, I'm hoping that we're on the rain side of this gigantic historic storm they keep hyping up every day. So with any luck, we're going to be on the rain side of it. What do you think?
We'll see what happens. I was looking at the forecast today for us for Friday. Who knows when you're going to be listening to this? It's saying it's supposed to be 63 during the day, thunderstorms at night, and then 29 for the high Saturday with 6 inches of snow.
The wind, I think the wind is what everybody's scared of here. It's supposed to be like a spring tornado, cyclone, combination of all above.
I mean, I love weather, so let's see what happens, I guess. But, I mean, where are we at? Ooh, we should mention, you know what we didn't bring up yet? This is our 1-year anniversary episode, John.
Yeah.
We were talking this time last year, well, both plantings, which we mentioned, but we were also talking about insurance dates, too. So those need to be coming up, and those weren't even on our list to talk about.
Yeah, it doesn't feel real wet and behind like it was last year, but we started this and we knew it was just concept. And now, flash forward a year, I mean, at least we sort of look like we know what we're talking about here in the studio. The studio is, of course, what makes it. But we were in the front table there in the front, and we were, I'm sure, just talking about whatever the markets were doing that day.
Yes. And you know what else I know? We were talking about them way too fast because that's the feedback we've gotten lately.
Yeah, actually, 2 things that guys have said is that once we get rolling on a topic, and I've heard this a couple times, that we not for the advanced guy, but for just the regular guy that wants to learn a little bit more, maybe we talk about it a little too fast and throw things like bull call spread out there, or implied volatility or standard deviation. It's just a different language in a lot of ways for stuff. So we will slow it down to some degree, and that leads us right into we do have, if you like what we say here, we now have a subscription section where guys can get us much slowed down. At least 2 times a week, I'm personally going to talk about a specific strategy and tie it into the markets, that we see today. In other words, it's not going to be like a college class exactly. We're going to use real world, real time application for something. I think I did one this weekend, and it was a bull call spread, and it will break it down. We'll really slow it down. So if you're interested in learning a lot more about the markets, in addition to daily insights, which is going to be be what we talk about here and a lot more detailed. We now have a subscriber section that you can go to at thehedgeheads.com and subscribe. So if you want that really slowed down version, it's going to be available to you. And again, at least twice a week, I'm going to really take my time and explain a certain aspect of trading or order entry, or it could be a lot of different things, and tie it into the markets, for that day. So it's going to be educational and informational. That was easy for me to say.
I like it. And in addition to that, near daily updates. If markets are moving, if there's something to watch, you're gonna have something to talk about on that side.
Yeah, today the update was out, and there wasn't a ton to talk about. And then after the update was up, a lot more to talk about. The stock market going down, even though we haven't got to the grains and cattle yet. The stock market is something we should talk about, and you could throw Bitcoin in there too, because if you're losing money in the stock market in Bitcoin, like the big players, they tend to take money out of other markets. So what have you seen today watching the stock market there, Ryan?
Yeah, well, I love to trade the micro Dow. So I've been watching the Dow. I'm not in. I'm kind of kicking myself for not getting in at the moment, but shoulda, coulda, woulda was last week's topic. So I love the micro Dow. It's down 850 today though. So, where are we going to trade? When I was looking, it was down 300 points. And if we're talking the micro Dow, each tick in there is 50 cents. So you're talking $50 over a 100-point move. Yep. It's there's no market that's safe, but you at least can. You're probably not going to lose your shirt.
Yeah, and this is a little bit away from hedging, but I mean, a lot of what we do too is just talking to a guy, and he might be farming, he might not. Yeah, and he wants to be in the stock market. So a lot of people don't even know that that's available here. You could be long, you can be short. It works the exact same way as corn or soybeans or any of the other markets. And what I like about the micro size is that it almost sounds like a commercial for the micro now. No, I like that you can, let's say you think it's going to go down. You would short it. You can short one micro contract, let's say it rallies 250 points, you're wrong. You can get another one. Now you have two, and you're in an average position instead of the big one where you're kind of committed to it one way or the other in different time frames. So there's different sizes in a lot of these markets. There's a micro oil. They're making micro grains, which I'm not so certain that we need that. There might be some farms with 200-300 bushels to hedge out there, but it would be just 50 bushels per. Is that what size of the contract it's going to be? It's going to be a really small contract, but they're developing these different sizes to meet different needs. I cannot wait till they do unleaded gas and diesel in the micro sized.
Those definitely need micros.
Yeah, sure. Everybody wants to hedge their fuel, and not everybody has 40,000 gallons worth of unleaded. Like I want to hedge for fishing and summer driving. I'm going to need maybe 500 gallons, not 40,000 gallons.
Right.
So it tends to be too big a contract. They tried half size, but there's no liquidity. Even that's a big contract. They do have the micro Dow or the micro crude oil, so that's the best you're going to do there. But I like seeing these different size contracts. And again, we don't talk about this because it doesn't pertain to hedging too much, but truly you could hedge your portfolio with this stuff too. As we've talked about interest rates in the past, you can hedge your interest rates with this. Anyway, the Dow is what we're talking about because that starts to affect the other markets, and that's what we're leading into. Is it's not all about corn and bean direction or cattle direction. It's that when you start taking 850 points off the Dow every day, money starts shifting around, nervousness sets in, the economy is going to slow down, and they start pulling money from one market out of like the Dow, or if they had like long positions and they were profitable in cattle, they'll start yanking that stuff out, and it can cause markets to go down. It's all that intertwined nowadays. It's hard to predict exactly what's going to cause what to do what, but when you start hitting those assets, and I guess you got to say Bitcoin's one of them nowadays. You can tell I'm a huge fan, but it does affect the other markets. And we didn't see that in cattle. Cattle had a huge Friday. it held its gains today. Cash jumped a bunch. But it will start affecting the markets, and that's so the outside markets really are the story today more than anything.
I mean, if you're making that argument, John, what you're saying is people pulled their money out of the Dow and the NASDAQ to move them into wheat and cattle.
Well, I don't think
the flight to safety. Even hogs was up today. That's what they're doing, I think.
Yeah, well, they've gone insane if they're doing that because
wheat's always the flight to safety.
Yeah, like I said, my client he said they're messed up the markets when feeder cattle looks like the safest one on the board, and it's true, and it did today. It looks like the most steady fundamentally, but this is the new markets. Hey, we got tariffs going. They're on, they're off. And China put some tariffs on Canada as well this weekend, which really affected the canola oil, which in turn affected the soybean oil. So this is what we do. All these interconnections, and then we filter it and try to give you the best information as fast as you can get. But there's been a lot of stuff moving the markets around. The latest, though, now is the Dow, and of course, Bitcoin's tied right to the hip with it, is trending down rather briskly, and that will start affecting a lot of these markets that we follow.
Absolutely. Speaking of market, let's get into our core markets. They want to talk corn, maybe some corn hedging. Guys are thinking about planting. What are we doing?
Oh, yeah. So the funds got out of a third of all their corn positions last week. I was a part of that. I was on the wrong side. So I was a part of the liquidation.
You facilitated them exiting? Is that what you're saying?
They facilitated me. So the funds got out of a lot of corn, but they still have a really long position, a substantial position. So that's not out of the woods yet either. They're heavily short wheat. They have been for a while, and they still are, and they are now short beans a pretty good amount. So when you look at corn, I'm trying to decide how I want to participate, and then not only is that hard to do, I can't decide whether I want to go with July or September options. And if you don't,
you love July.
And if you don't watch out, I'm going to retell this story for the 100th time.
I know how much you love July,
but it's you got a tighter supply up front there, and so I lean July one day, and the next day I lean September. September is going to get you all of the weather for the summer. That's what the difference between July and September. July seems like it does. It seems like a great name for an option I want to be in, but it doesn't get you to the 4th of July. It gets you through the third week in June.
Yeah, June 20-something.
And then go look at a 2012 chart and tell me which option you wanted to be in. And I can tell you that it wasn't the July one. That actually ended on the low tech. So September not only was the right option, it would have essentially forced you out on the highs, I believe. If I'm not mistaken, it's been a while now, 2012. That's 13 years ago. That on the expiration of the September option, I believe was the high for corn, 841. I might be wrong on all that. I know it was August, but I think it was within a couple days of option expiration. So unless you wanted to be long the futures, you would have wanted to get out, and that would have just essentially forced you out on the high to make that decision, stay with it or get out. And if anybody stayed long at 841, I meant or was it 14? I don't
remember.
It was one of those two. Anyways, you wouldn't have probably wanted to stay long. So actually September was the perfect option that year, and it made a lot of money for those guys that were smart enough to buy September and not July.
Sounds like maybe you want to do a put spread, a calendar spread. Buy a put and buy a call.
Oh, and I did that. Yeah, I left that part out. I bought December puts. How could I possibly lose? How could both July calls be wrong and December puts be wrong that year?
And
it would be impossible to thread that needle. But somehow the markets did that perfectly, and I lost on both sides. Yes. Yeah. 2012, while everybody was enjoying the bull market, because that is the one market that everybody makes money in, unless you're, of course, short somehow. It goes up every day. You hear the news. Then you can pick up a phone and buy it, and it still goes higher. That's when you know you're in a bull market and a drought. So everybody's having fun, and I'm still telling the story to this day. That's the fun I had. I'm sure it was going good. I don't remember it being a bad time. But anyway, so that's why the battle between the July and September.
Okay. in the interest of slowing down a little.
Yes.
Let's talk July and September options, though, because we mentioned them a week or two ago, but July is really the last old crop contract. September is, well, it's not technically new crop. It trades like new crop. So how does that affect these options?
Well, it's funny. September oftentimes trades like old crop until about midsummer, and then it trades like new crop. Plantings can be really delayed, but with the seed technology nowadays, it really, you go ahead and look at the spread history. There is definitely an answer what September behaves like more often than not. But it's not uncommon to see September, 20, even 30 cents over the price of December. But if there's one constant, it's where ultimately that September ends up. Now, there's no black and white rule on that, but it definitely has a history, and it is treated more like new crop as you roll towards new crop. And it fits right in there with the elevator games where they roll. If it's inverted, they roll really early. If it's at full max carry, you got all the time in the world to roll that thing. So September is just this contract that a lot of guys forget that's even there, but it provides a lot of spread opportunities throughout the year. And it also provides possibly better marketing opportunities depending on the timing of it. But for this, I'm just looking at some long exposure for summer weather, for hot trade deals. Who knows what's coming? All this stuff, I'm looking for some upside, and I'm trying to decide if I'm going in, number one, and then what month. And I haven't decided. Which way do you lean?
I go back and forth as well. So I rarely trade the September contract to be, up front. I like the July, but I'm usually out of everything by mid-June and to the sidelines, except maybe wheat. I start looking at wheat more in the summer.
Yep.
And so I typically am in the July contract, but I'm not holding past that second week, and I rarely look at even getting in those until end of May, last week of May, early June. Right now, I'm just a shopper. So then that's why I don't look at, but I'm a short-term guy. You know that. So
yep.
I'm not your hedging guy.
That's why there's a good chance that the third thing that could happen, we'll talk about this till the one day it blasts off and then we completely miss it.
Right.
There's a good chance of that, actually. No, it's a market to be patient with. It's not an easy market. It's not one where it feels like you should keep your powder dry. And look for the opportunity. Nothing's really clear. I think we got a USDA report tomorrow. What are they expecting? 1.51 from 1.54. Does it even matter? Now, if you see a 1.4 or 1.3, that will matter quite a bit. So as long as it's in the 1.5s, I don't think the market's really going to care. Now, the big report is the March report. That's coming up at the end. We're going to be talking a lot about strategies that you could use going into this report and then after this report. We won't do that today, but we definitely will. And behind the subscription, we'll talk about it quite a bit as well. And then we'll go through a little history on what that report usually says. But everybody's leaning corn acres and more corn acres. It's 70 degrees outside and it's early March. And it feels like there could be some corn acres this year for sure.
Well, I could tell you no one's calling me about soybeans. So
yeah, we're not even talking about soybeans anymore. No one wants to talk about soybeans. Because, mainly guys are sold out of them by this time of year. There is still some kicking around out there, but really it's really fallen out of favor. Now, a lot of people argue that the corn acres are fringe acres and it doesn't matter. And beans are cheaper to plant. For sure, it's going to be beans. This debate happens every single year. And then the March number comes out. Why we think there's more corn acres, or at least I do this year, is because of the insurance price. The only guarantee that you're going to get your money back. But what guys do like about beans, though, that has changed a lot is they can plant them a lot earlier, and they do plant them a lot earlier. So that whole weather window used to be a huge deal for corn and bean acres. Now it's a really blended window. And with equipment that we have today, it just seems to get in. So the number used to be weighted a little bit, if the weather was kind of wonky and looked like it was going to be delayed spring. This one, the snow's melted, so they'll use that late March number and they'll put a lot of weight to it, because the weather is cooperating right now to what looks to be an early spring. And I jinxed it for the second time today.
Well, maybe that unjinxed it.
Yeah, that's true too. Yeah. We're very wary of that in this area because we get like 3 months of warm weather, which I don't mind the in-between at all, except for our in-between for spring and summer now is 38 to 42 degrees. And then 1 week it's 97 in the middle of May. And that's the way it's gone for like 4 years now. So I don't mind those 40s and 50s, but it's just this extreme line we've had in spring. But we've had extended Octobers, Septembers, and Octobers. But it'll cycle back to a regular spring. Or I keep saying that. I at least trying to convince myself that's going to happen.
I mean, I think we're due for an early spring. We'll see. I mean, it feels great this week, so let's see what happens.
Yeah, except for the bomb cyclone. That's coming.
Oh, man. I love that name, bomb cyclone.
It makes it sound dangerous.
It does. I'm just excited to see what happens, but maybe if I was a producer, I wouldn't be, especially not if I had cattle.
Yeah, I think everybody's coming back from wherever they are in their winter haunts. If you left, I didn't leave, and it won't be long before you're stuck behind some large piece of machinery going down the highway, and everybody will be planting. And
that's fine as long as I'm pulling my boat while I'm behind them.
Yeah, I get frustrated real quick. Then I remember, do the math. You're really only going to get to your place that you're going probably 35 to 55 seconds faster, and guys need to use that highway too. But we are. You'll see guys scratching around very, very soon in the fields, already way down south. Of course, that's happening. But it is that time of year, and we got the next 20 days to argue about the acreage too. So we got that to look forward to.
Yeah, I'll be interested to see, bringing up soybeans here. There's got to be just the way the markets work. The fact that no one's talking about soybeans, no one wants to talk about soybeans makes me want to do something with soybeans. I just don't know what to do.
Well, that's where the implied volatility comes in. And now, again, that is what they think it's going to move in a certain period of time. That's the very, very scaled down version of it. So it's very high in corn right now, which makes the options expensive. Good if you're a seller, bad if you're a buyer. But the soybeans, on the other hand, have a very low implied volatility. Not historically like this is the best deal ever, but still it's well within the standard deviation range of +1 and -1. And that makes them a good deal in front of the summer weather. I'm very interested in soybeans getting something on, whether it's curve calls, bull call spreads, or just regular calls, or, I'm not going to go on the long right now on beans, but I want to get some exposure for the summer. So I'm glad you brought it up. That is always a sleeper, and then it wakes up. And if you're on the right side, it can be really fun.
Yeah, definitely. The options in soybeans can be very exciting either way.
Yeah, it can be a snoozer for months, and then all of a sudden when it wakes up, it's something else. But the premiums really aren't that bad on them. I think, what was it, 31 cents the other day for an $11 call. I'm certainly not buying that right now. If you look at the seasonals say you can wait quite a bit on this. With the news the way it is right now, who knows? They took a hit today because soybean oil was down because canola oil, also known as rapeseed oil, had 100% tariff from China. So again, there's news every day, and it's just you take it day by day and try to navigate the market. So I'm trying to be patient and not getting excited. I tend to be early in things I want to get into. So I'm trying to be patient this year.
Good luck.
Yeah. I'll watch it tick up 5 ticks in a row. I'll say, oh, here comes the bull market, and then I'll buy it. But I will at least attempt that.
Yeah. What about crude oil, John? Who would have seen this a week ago? Oh, wait, you maybe mentioned it.
Yeah, it's crude oil is seasonally in a week window, and it's been a week. And now we're going to enter unleaded is March, I think March 17th. And then the diesels towards the end of March. So the seasonals do flip. If you want more details on that, message me and I'll go over the specific seasonals. But they do flip. But I also think there's a lot of politics going on right now with Saudi Arabia and Trump and talks. So expect a lot of volatility there. It's not a market I'm super interested in. Maybe on the micro side of stuff, for summer gas hedges. I don't know. But yeah, we're seeing really low levels, but that ties right in with the stock market. I'm sure we're at multi-monthly low levels right now, if I'm not mistaken. I mean, what is it, 65 today? 65 something?
Yeah, for crude. And I have been watching. I do have a guy who's in, so I've been paying attention for him. I do like I love the micro crude contract. Speaking of micro contracts, that one's $1 a point move.
Yeah.
And man,
every dollar is $100.
Yeah, every dollar move in oil is $100. Yeah, and it can be a great contract to trade, especially when you do have some volatility like this.
Yeah, actually, crude oil has 3 different sizes. You have the 1,000 barrels, and that is every dollar is $1,000. That's easy math there. Then the half size, 500 barrels, is $500. And then the micro, like we were talking about. So that's got 3 different sizes. Gold, that's another market that has 3 different size contracts. So I do like the micro too, but you just remember you also have the half size on that one. That's a contract that a lot of commodities don't have, is half size, but crude oil does. And it trades every month.
Yes. And all the contracts are very active. There's plenty of open interest in all of them, plenty of people
deeply
trading,
liquid and
volatility.
Yeah, but it is open essentially 23 hours a day, or 23 hours and 15 minutes a day, or unless that's changed. So it can tend to be a very volatile market when you're sleeping. A lot of news can happen. A backhoe a couple years ago hit some sort of important pipeline. Some poor guy just working on something somewhere hit something really important, and that sent I think it unleaded up 31 cents that day, but by the close it was already coming down. So it's a volatile market, but again, just one of the pieces of the puzzle.
Yeah, absolutely. Well, Jon, we mentioned the flight to safety of feeder cattle today, but we haven't really talked about cattle at all. What do you have on cattle?
Yeah, we got off on all kinds of crazy tangents. So, what we do here, so I had a conversation today. So this is what I'm going to do tomorrow. So I'm going to call a banker with a feeder cattle guy who's just bought a bunch of feeders at various sales in South Dakota, Minnesota, and North Dakota probably. We're going to be looking at covering them or going at least through the numbers. So I'm going to talk with the banker and him in the same phone call. Or I'll talk to the banker first, lay out maybe some ideas that we have, and then bring in the client. So what my point is, we're going to work on a strategy that makes the bank happy, makes the guy that bought the cattle happy, and if the numbers work, then we're going to apply it. So that's how hedging works. I prefer not always to contact the banker, but I have relationships with them. Having a good relationship with the banker and making sure everybody's on the same page before you put the hedge on. So we're going to go over the pros and cons of doing it this way, whether we're just buying a put. We might be looking at selling a call and buying a put. We might be just looking at shorting futures at certain price levels. We might short futures and buy calls, at certain price levels, or a combination of both. But that's what the meeting is going to be about tomorrow. And that's what I have to do after we hang up here, as they used to say in the radio days. So we're going to go over the numbers, but the banker is going to be involved. The guy with the cattle is going to be involved. And then we're going to see if anything makes sense. And if it doesn't, we won't do anything. If it does, and we find some ideas that work, we'll probably start applying them fairly soon, or when we think the market's done going higher. We are going to try to time it the best we can. So we'll use seasonals, we'll use fundamentals, we'll use a number of different things. But So we're going to have a meeting and we're going to try to figure out a good hedge for cattle. And that's what we do every day. Whether we're talking to bankers, sometimes we're just talking to the producer and figuring out a hedge plan. Say I have 10,000 bushels. What should I do? When should I roll this contract? These are conversations we have, and we try to work in the banker when he needs to be worked in. Otherwise, we're just trying to figure out all these different puzzles we got every day. But for tomorrow, it's going to be conversations with the banker and the cattle guy and trying to figure out this mess. Because what's really going on in cattle is you have very expensive cattle in a bull market and it's going higher and everybody's happy so far. But when the music ends, that's where the problems can begin. So if it can be prevented, some guys go with a philosophy, hey, I'm going to buy it $20 put out of the money. So it's my break even. Worst case scenario, I'm staying in business and I break even. The next guy is going to try to get a combination of stuff where maybe he has $5 or $6 open to the upside, but he has he's got his floor $4 away. He's got upside risk to some degree, but he can be wrong for $4 or $5 more to the upside. And then some guys will just short the contract. There's just many different ways to go about it. Or you could short the contract and buy a call. Do any of these work? Well, that's what we're going to do. We're going to go over the numbers and try to come up with the best plan for what fits this particular ranch with this particular banker. And just, like I say, have a conversation. That's what hedging's about.
Absolutely. And it's different for each person. So even if we could offer recommendations or say you should do this, that wouldn't be right for every person who's listening to this.
Yeah, and I've never been a fan of the cookie cutter, this is what everybody should do. This is what the newsletter tells you to do. I've just never been a fan because guys get into stuff that makes them uncomfortable and then it goes wrong from day one. They're not comfortable with the risks. They're unfamiliar with it. So I work with a lot of new guys and it's a process. And that's why we started this podcast and then why we started the subscription side of stuff is it's a process and you need to learn a little bit every day. And hopefully you, a few years down the road, have the tools that you need by yourself or with your favorite broker, together trying to figure out these markets. And, but it is definitely a process. And I feel there's a need, there's a lack of information out there where to even begin. And guys can maybe start way too fast and get in over their head right away. Or you might have just a seasoned veteran with ultra deep pockets where he's short a lot of contracts or long, and he doesn't bat an eyelash to the guy that wants to maybe buy a put or maybe protect his cattle maybe once a year, and he wants more information. Anyway, that's what we try to do, try to cover all that. I have a real soft spot for guys that want to learn because I feel there's not a lot of good resources out there. There's some, but it's always kind of been that way in commodities. So if I can help a guy, I'm more than happy to have a number of conversations and try to figure it out like everybody else.
Yeah, I think it's an important point. I mean, there's guys that got $3,000 in their account and there's guys that have $300,000 in their account, and how you hedge is going to be very different.
Or millions. With ACH, yeah. It's always changing. That's really changed the landscape of what we do too. ACH, so the money tends to get sucked out for interest, especially with interest nowadays, and then it gets put back in for margins. But back in the day, there would be 5 days, minimum for margins, and you could go out to 10 days in the good old days. Well, it was frowned upon, but you could. But nowadays it's all very streamlined. You have to have it in fairly quickly, but the money does flow in and out of a firm like this fairly quick, depending on the hedges. So if you're not using your hedge money and you're not buying loads of cattle or you're not planting for a few months, you might take all the money out. You might leave some back to do other things. So that's another thing that's really nice now with ACHs. It's very easy to get the right amount of money in for what you need on your hedges very quickly, one way or the other.
Absolutely. And especially, like you said, in today's interest rate environment, it's if you're using a line for your hedge, it's nice to keep the money on the line and not. in your account.
Yeah, if you're paying interest on it, you're going to want to get it out. But that's what it's so easy to do. You press a button, and away it goes either direction. So it's nice. That's nice for hedging. Nice tool to use. But yeah, I'm looking. I think we should end this so I can go outside. This is a very nice day.
It's definitely a day to get outside. So don't forget to visit us at thehedgeheads.com. And John, if they want to call you,
218-731-1578.
Thanks, John.
Yep. Needed to be shaved really quick. The black high cheek hair.
You just shaved in that time?
Yeah, it's just a little bit on the high
just
end.
on video, John. I didn't know you were so...
Well, it's the black high. You don't let your ear hair go, your nose hair go, or the high cheek beard hair go. You can.